So, India's economy during July to September grew at its slowest pace in the last 7 quarters.
Fresh GDP numbers are out and they do not paint a good picture. In the last quarter, India grew at just 5.4%. That's a 2-year low. In the previous quarter, the growth rate was 6.7%. So this is a sharp decline. It's also well below expectations.
Even the lowest respondent in our poll did not have a number lower than 6.3%.
What about India's Reserve Bank, the central bank? It was aiming for 7% growth rate for the entire year. Now that target appears tough.
Manufacturing growth was anemic. Mining activity actually fell a tad. Services did well, but financial services did not. Consumption remained weak. We all know private spending hasn't picked up for years, but now even government spending has been very, very subdued. All eyes are now on the RBI policy meeting on Friday. Will numbers be recalibrated? Will there be an interest rate tweak to revive the economy? We ask all these and more questions today. The primary one, however, is it time to re-examine India's growth story? It's Tuesday, the 3rd of September. I'm your host, Anirban Chaudhary. This is the Morning Brief. My guest today is noted economist and former member of the Monetary Policy Committee, Ashima Goel. Welcome to the Morning Brief, ma'am.
Thank you. I'm happy to be with you.
So my first question obviously is, what do you think are the 3 things that went wrong this time?
Well, I think that real interest rates have been high for quite long. And the interest elasticity of durable consumption, housing, etc., it's quite high. But in India, there's a belief that everything is determined by income rather than interest elasticity. So maybe there was less attention paid to the real interest rates becoming really high. The same thing happened in the 2010s. Whenever real policy rates exceeded 1% persistently, there was a slowdown. And we are seeing a repeat of that. Now, it's very sad that we don't seem to have learned from history. And if you look at the components of GDP, manufacturing, construction, investment, where the major slowdown has occurred, these are all interest-sensitive items.
Absolutely.
And so therefore, and also export growth has slowed. Now that we knew that there were global stresses, but one of the things that worked after the pandemic when we had robust growth was that policy was counter-cyclical. And this is also quite unusual. Why this is something people have missed? Because one of the things that debate currently people seem to be saying is that there are a lot of possible volatility with the Trump election and so on. So therefore, you need to be very cautious and you need to hold rates and not really stimulate the economy. But what worked over those past 3 years was there were these shocks and policy reacted. So if there was a growth slowdown, if there's global volatility, the domestic demand should be stimulated to compensate. But that was not done. So I think that is the other thing that was missed. And the third thing is that there's been prudential macroeconomic tightening, because in certain areas where credit was growing very rapidly, above 30%, personal consumption loans, credit card loans, etc. Then we know as economists that whenever credit growth is very high, that can lead to problems later. So the idea of prudential regulation is to tighten in those specific areas. But what happened, unfortunately, is that there was an election year. So government spending also reduced. And I think this is something we should congratulate ourselves on, because earlier, a lot of money used to go into the economy during elections. But we see a lot of tightening of all this, the kind of leakages that used to take place, the kind of election spending. And actually, government spending fell drastically through those election months. And again, when you say counter-cyclical, the point is prudential, fiscal, monetary, everything was tied together. And that is not good. So monetary policy had room and could have relaxed. The idea of macroprudential tightening in some sectors is that monetary policy has room to relax then, but it was not relaxed. So everything was sort of tightening together, which is not healthy.
Understood. We'll come to the monetary policy. We have a meeting by the end of this week, and we'll come to that. But the fact that everybody got it wrong, including the RBI, do you think there was something that everybody seems to have missed?
Actually, this I used to say in the MPC also, partly because in our inflation basket, there's a dominance of food. A lot of attention is paid to individual food price items. So tops, tomatoes, onions, potatoes, whether it's milk or oil or fats. And the analysts also, they're paying so much attention to these kind of factors that they ignore the underlying macroeconomic factors that are really ultimately driving demand, supply. And also, there's too much herd thinking. If somebody says something, or especially the RBI is putting out these forecasts, you see that analyst forecasts tend to converge to it. So I think the other thing that's really required is to have independent academic forecasts and analysis.
Right. You spoke about food prices and inflation. There is a debate on whether it should be part of inflation, part of the CPI. The RBI has very strong views on it. Do you think excluding it will make a difference in how we see various sorts of numbers that are markers of the economy?
Well, I think this is not going to solve matters because our consumption basket food does have a high weight. Although the base is dated, and if you update it, which you should, the weight will go down somewhat. But still, it matters a lot for the consumer's perception of inflation.
Absolutely.
And so another of the factors over the last few months has been that core inflation, the part that excludes these volatile components, has been really coming down. It's been below the target, which is 4. Yeah. But food prices, you've had these because of the exceptionally hot summer, then uneven rains, whatever. You've had spikes in vegetable prices. So I think the government and this debate coming up that exclude food is partly because another of the things that really worked after the pandemic was this cooperation between monetary and fiscal policy, where fiscal policy used to act on these supply side factors that are affecting food inflation, and they can be more effective at that. So there's both short-term and long-term kind of policies. You can have counter-cyclical excise on oil or food stock management release, etc. But what is really required here, and I think the government was feeling now that there's too much pressure on them to keep food prices low. They also want to give higher prices to farmers and so on. But what can work for them is to have sort of longer run, because the consumption basket is changing. People are switching from food grains towards vegetables, other items, a diversified food basket. But the government policies are very much focused on food grains. They spend a lot on that. While currently you need to do something to facilitate the food supply chains. I always say that in a UK supermarket, you will never have tomato prices going up by 600%. Because you will get supply coming in from other places. And it's not the government that does it, it's private parties. In Delhi, you had that 600% rise last summer. And it was because they're getting all their tomatoes from Himachal. And there were floods in Himachal. So this summer, again, there was a spike, but not that much because they also started getting hybrid tomatoes from Karnataka. So this kind of diversification of supply chains, there are certain problems, and it's at the state level. Very often there are restrictions on outsiders coming in, the suspicion of private business, with the FPOs, the farmer producer organizations that could play a role are not so well equipped, or the governance needs to be improved. So a lot of initiatives, both from the government and the private side, I think to change this kind of food price volatility that we have been seeing, which has impacted monetary policy.
Got it. Right. Just picking up on the various segments that did not do well, manufacturing and mining have either slowed down or shrunk, respectively. And private spending has been a problem for the last 3, 4 years. And
Hmm.
where do you think this is going?
One important signal in the current data is that consumption has grown at 6%. So
Right.
people have been saying that urban consumption is slowing, that this is due to the K-shaped recovery, due to
Right.
various structural problems, and you need fundamental changes before India can grow. But, this is a thesis I don't agree with, because the kind of robust growth we've had, above 8% for 3 years after the pandemic, it's not just a pandemic bounce back. Huh? It shows, I think, in India, strength is a sort of economic diversity. Even if merchandise exports are not doing well, that those GCC centers coming in, service exports
Right.
are doing very well, right? And this
Mm,
time, agriculture was down for a few years, but during the pandemic period, agriculture was really doing well while manufacturing was down. Now,
mm,
again, with
mm,
the rains, we're expecting agricultural incomes to go up. So, if consumption has grown at 6%, yes, last year it was overall, I think it was about 4% in H2. While it had grown in Q1, it's above 7%, and it's come down to 6, but that's still healthy growth. And even if you
right.
look at our overall ratios, where consumption is about 60%, above 60% of GDP, private consumption, right? But in
Mm,
China, it's 40%. So how can you say that in India, consumption is inadequate? It isn't. We have a very good balance between consumption, savings, investment, government spending. So this is part of our diversity that supports growth. For
right.
investment also, we used to see in the MPC that there are certain sectors where investment is picking up. But
Mm,
people talk about the absence of a broad-based rise in private investment. Now, see, our investment ratios are above 30% of GDP, which is not small. And government investment is not more than 6% of GDP. So it is actually a very large private investment taking place. But most of this is household, where the household sector in India is defined to include unorganized manufacturing.
mm,
So
mm,
it's a lot of investment by small firms also that comes in this. Then
right.
household construction, building houses, the construction sector has been booming. So when people say investment is not picked up, it's corporate investment narrowly, the
Correct.
large corporate.
Capex cycles. Right.
Yes.
Mm,
But even in that, some sectors such as, say, steel, cement, etc., there was investment taking place in
right.
specific areas where demand was high and they were coming against capacity constraint. There was investment taking place. So, but when people compare with the 2000s, when there was the last investment boom, and they say investment boom has to look like that. It can't look like that, because that private investment boom was driven by private investment in infrastructure,
Absolutely.
which created all those NPAs and risks. So we don't want that repeating. We want investment to grow in a steady, sustainable way. The RBI has a large corporate survey,
Mm,
but now the aggregate data again is showing some slowdown in that.
absolutely.
Mm.
Government spending, you made a really interesting point about how it's a nice sign that during election time it was
Mm.
subdued, which is very different from what has happened earlier. But
Mm.
overall also there seems to be sort of negative sentiment about why public spending isn't increasing or growing at the rate that it should. How do you see that?
No, I think that after the pandemic, there was a serious attempt to increase public spending and improve its quality, improve the share going to infrastructure, which reduces the sort of supply bottlenecks that create inflation and reduce productivity. And I think when we talk about monetary fiscal better coordination, this was a major part of that. Because if government is going to spend on something that is in short supply and would create inflation, this is what happened in the 2010s. We had very high food inflation, and the government, after the global financial crisis, was spending a lot of money in agriculture, farm loan waivers, and construction. And we had real wage growing in double digits. and sustained inflation. There's the same thing now with these largely BEHNA schemes. I'm a little worried by that.
Right.
Because this money is going to be spent by low-income women on a diversified diet for the family, which is a very good thing. But then if you have all these constraints in the vegetable supply chain, it's going to impact prices there again. We saw this in the US because they gave this huge amount of transfers and supply chains were choked because of the pandemic.
Right.
And then they had such high inflation and it led to worldwide inflation, which central banks have been just struggling with and just winning the battle. So I think the government is serious about spending and about improving the quality of spending. But unfortunately, this is more in the center. Fortunately, state level spending, there is a cap on their borrowing. Constitutionally, they can't increase their deficits beyond some.
Right.
And so that is giving a warranty for macroeconomic stability. Yeah.
Understood.
But it means that investment, which had risen at the state level, has come down over the last year. Investment expenditure because of these schemes they're choosing to spend on. And here the RBI was really looking at this, to revive growth. They're saying that this slowdown in Q1 is temporary because government is going to start spending.
Correct.
But there's a limit to how much we should depend on the government for everything.
And now, of course, coming to the question that is on everyone's minds, RBI policy meeting is on Friday. You mentioned about interest-sensitive segments. You were part of MPC. You're now part of the shadow MPC or EGRO. I believe there was a meeting today or yesterday, and there were very interesting points raised. So questions, two-part question. What do you think RBI should do? What do you think it will do? And would they be divergent?
So the MPC is going to face a dilemma because in October, headline inflation had exceeded the upper tolerance band. It was at 6.2, above 6%. But then growth, the Q2 numbers have come in at 5.4% GDP growth, which is much below the 7% target RBI has set. And the figures, everybody, even in the finance ministry had 6.5. Most analysts were around that figure. So it's come in much lower than anybody expected. And therefore, what do you do? Do you focus on inflation or do you worry about a slowdown in growth? So when I look at these numbers carefully and the structure, it seems that the inflation is just due to vegetables, maybe palm oil, fats, but palm oil, internationally prices are falling. Vegetables, winter, we know that prices fall and it's a good monsoon. It's a transitory rise. We expect headline to fall towards 4 because also internationally now oil prices are softening, which is a big plus for us as oil prices fall. Trump is threatening to end the Ukraine war in one day. I don't know if he will be able to do it, but overall, we expect inflation to soften and monetary policy has to be forward-looking. So look at future inflation. And if that is much lower than our current repo rates, that means real interest rates are above 2%. And since core inflation continues to be low for industries facing really high real rates, then when you look at growth, then as we said, the interest-sensitive sectors and the slowdown that has been accumulating for quite some time. While interest rates were high. So it looks like a trend slowdown. So policy should actually act to reverse that trend. They need to act fast because monetary policy acts with lags. So they need to cut rates. And they have the space to do so because the inflation spike is temporary.
Right.
But when you interact with your other question about will they do it, when you interact like in this EGRO shadow monetary policy, there are economists from the market, from banks, and they really follow what the signals coming from the MPC and the governor very, very carefully. And the governor has been focusing on the inflation target at 4%. And so their perception is that because of the strong guidance, if they cut, then it will be perceived negatively, that things are really wrong, etc., etc. But in most emerging markets, country like India, because of this volatile commodity inflation, you face a lot of supply shocks. And this has been happening worldwide. And so when you face this kind of uncertainties, you can't give forward guidance. So the forward guidance that the market assumes a governor has been giving when he's been focusing on the target, it's data dependent. It is dependent on high growth. He said clearly that because growth is high and he believes it's robust, we can focus on inflation and on reaching our target. But if the data itself has changed, the data based on which he's making this statement, yeah, the markets need to look at that data. You are giving them, explaining to them what your reaction function is. You're saying you will raise rates if inflation is persistent, if inflation is above its target, if growth is robust. Because the agreement that the RBI has with the Ministry of Finance is for flexible inflation targeting, which is designed to be within your bands, and you have that band from 2 to 6. You have a target at 4%. But if you exceed that band for more than 3 quarters, then you have to explain and say how you're going to get back. So those 3 quarters are designed to allow you to absorb supply shocks. So according to me, they have space to act. They have the freedom to act. And in my view, they should act. Now, as I said, we don't give forward guidance in the MPC. So I don't want to predict what they will do. But according to me, they have the room, and if they want to, they can act, and they should act. Yeah.
Understood. Going by what you said, I'm not talking about people who are raising, alarm bells of stagflation when inflation is high and there's a slowdown as well. And although you've said that, we've been slowing down for a while now, but you don't see inflation as really sustaining at these levels. But do you think overall it's time to sort of recalibrate what we call India's growth story?
I think the signals we've got in this extraordinarily rich data point suggest that it's not true. The slowdown is cyclical. There are no structural factors that will force India's growth to fall. If policy is adequately counter-cyclical and supports growth, it can continue at a higher level.
On that note, we wind up our conversation and episode. This episode was produced by Surohini Jain and Neil Ghai, sound designed by Amrit Reggie. The Morning Brief drops every Tuesday, Thursday and Friday on an audio platform of your choice. Keep listening. All clips used in this episode belong to their respective owners. Credits are mentioned in the description.